Well, for the past quarter, cement demand remained strong, but prices declined. But the lower prices, well, they were partly offset by input cost tailwind. Let's take this piece by piece then. On the demand front, January was weak due to weather and pollution-related restrictions, but there was a growth pickup in February, and March was the strongest month. Volume growth is likely to rebound in Q4 on account of heavy discounting pushed by companies and also a pickup in year-end construction activity. The street is expecting the industry demand at around 8 to around 9% in Q4, which is a big improvement on a sequential basis. For the year, well, the derived volume growth for the industry is likely to be around 9% odd. On a regional basis, South was underperforming, while West as well as Central India, well, they were the best performing regions. Cement prices declined continuously for around 5 months after the price hikes that were taken last in September to October 2023. Realizations in Q4FY24, well, they're expected to plunge by close to around 5% on a sequential basis, despite being a seasonally strong quarter. Prices were impacted by what? By intense price competition among the larger companies as they were trying to gain market share. The highest decline in prices on a quarter-to-quarter basis was seen in East India, which was at around 8% odd, which was followed by other regions, which is in the vicinity of around 3 to around 5% on a sequential basis. But spot international coal and petcoke prices in March, well, they reverted to December 2023 levels. But they're still 5 to around 14% lower in comparison to the averages that we saw in Q3 as well as in Q2. The operating leverage on a quarter-to-quarter basis and flat to declining variable costs, that's what's going to keep the overall cost for the universe under check, declining by around 4 to around 6% on a Y-on-Y basis, and sequentially as well. Well, Jefferies expects stocks under their coverage to see EBITDA per ton dip of around 110 rupees per ton, that's on a sequential basis, but it will grow by around 125 rupees per ton on a year-on-year basis. The EBITDA per ton for most companies will show a growth, with ACC best placed due to the easing cost, volume growth from the recent capacity additions, and also benign valuations in comparison to its peers. Part of growth on a year-on-year basis is because this EBITDA per ton is coming on a very, very low base. Well, Jefferies has put their expectations of the potential out and underperformers for this past quarter. Among the larger peers, well, they expect the highest year-on-year growth for Ambuja at the consolidated level, while Ultratech and Shree Cement are expected to grow by around 18 to 27% in terms of EBITDA growth. Among the mid-cap names, well, Dalmia could potentially underperform with a sub 10% growth, while JK Cement as well as Birla Corp, well, they could outperform with near 50% EBITDA growth. Well, let's wind this down with a quick valuation check, and the snapshot comes up for you on the screen with the valuations as they stand as of now. Well, given that we are in the midst of a general election activity, we could see some slowdown in terms of demand, but the key to track from here on will be price increases that are pushed through, how much of that is absorbed, and also the demand recovery that the street is expecting in the second half of this fiscal.